Hello, Janot Trust here. In this video, I'm going to go over what would happen to your investment if, the big ones, the Fidelities, the Vanguards, and the Schwabs were to collapse. So let's break it down in this video, okay? But before I proceed, hit that subscribe button and the like button. Come on, you're going to get a lot of value in this video, so hit that subscribe button and the like button. So if Vanguard, Charles Schwab's, and Fidelity were to go bankrupt, the impact on investors would be minimal due to several protective measures in place. Number one, you have the asset segregation. So the assets held by these brokerages, be it stocks, bonds, ETFs, or mutual funds, are kept separately from the company's own assets. This means that even if the brokerage firm fails, your investments remain your property and cannot be used to pay off the company's debts. You have the SIPC protection. So the Securities Investor Protection Corporation, SIPC, provides insurance coverage up to $500,000 per account, including up to $250,000 per cash. However, this protection is mainly for cases of theft or if securities are missing, not for market losses. Next, you have transfer of accounts. So in the event of a brokerage failure, another financial firm would likely acquire the failing company's assets and accounts. Your investments would be transferred to the new custodian with minimal interruptions. In regards to ETFs and mutual funds, these investment vehicles would continue to exist and operate even if the brokerage managing them went bankrupt. The underlying assets would still be held by a separate custodian. There is regulatory oversight as well. Brokerage firms are subject to strict regulatory requirements, including maintaining certain levels of capital and segregating, client assets. Now, how the market will react if Vanguard, Charles Schwab, and Fidelity went bankrupt is a completely different thing. So the immediate market turmoil, right, the bankruptcy of any of these major financial institutions would likely trigger a sharp decline in stock market indexes, right, due to the panic selling and uncertainty, increased volatility across various asset classes, so a potential flight to safety, with investors moving money into perceived safe haven assets like government bonds or golds. There's the longer term impact, so like financial sector concerns. The failure of a major brokerage would raise concerns about the stability of other financial institutions, potentially leading to increased scrutiny over other brokerages and financial firms, possible contagion effects within the financial sector, regulatory bodies implementing stricter oversight and new regulations, right? Like investor confidence. So while investor assets would be protected due to asset segregation and SIPC insurance, confidence in the financial system could be shaking, resulting in reduced retail investor participation in the markets, a potential shift towards alternative investment platforms or methods, increased demand for transparency and scrutiny measures from financial institutions. In regards to market structure changes, the bankruptcy of a major player could lead to significant changes in market infrastructure. Other financial institutions might acquire the failing company's assets and accounts, a redistribution of market share among remaining brokerages, potential consolidation within the industry. So to protect yourself from the potential bankruptcy of a brokerage firm, you're going to want to consider the following strategies. You choose a reputable brokerage firm. Select a well-established, financially stable broker that is a member of the Securities Investor Protection Corporation, SIPC. Also, diversify across multiple brokers. Split your investments so you have no more than $500,000 of any stock in any, brokerage. Limit uninvested cash. Don't hold more than $250,000 of uninvested cash in your brokerage account. Keep excess funds in your bank account until you're ready to invest. Understand SIPC protection. So SIPC provides coverage up to $500,000 in securities, including $250,000 in cash per customer account. Keep accurate records, right? Maintain either hard copies or electronic records of your holdings, account statements and trade confirmation. Monitor your broker's financial health, right? Stay informed, about your broker's financial condition and regulatory compliance. Consider additional private insurance, right? Some brokers offer protection beyond SIPC limits through private insurance policies. Be aware of account segregation. So ensure your broker follows the SEC's customer protection rule, which requires them to keep customer assets separate from the firm's assets. Now, how does the SIPC coverage work in case of a brokerage firm's bankruptcy? Because that's very important. So the Securities Investor Protection Corporation provides protection for investors in case of a brokerage firm's bankruptcy. So the way it works is the initiation of liquidation. So when a SIPC member firm fails, SIPC typically steps in and asks a federal court to appoint a trustee to liquidate the firm and protect its customers. Next, you have the account transfer. The trustee first attempts to transfer customer accounts from the failed broker dealer to another SIPC member broker dealer. Customers are notified promptly and can deal with the new firm or transfer their accounts elsewhere. You have the direct liquidation. So if account transfer is not possible, the trustee liquidates the firm and returns assets to customers. In regards to coverage limits, the SIPC provides protection, again, up to $500,000 per customer account, including a maximum of $250,000 for cash claims. In regards to asset replacement, SIPC covers the replacement of missing stocks and other securities when customer assets are missing due to theft, unauthorized trading, or are at risk because of the firm's failure. The non-covered items, the SIPC does not protect against market losses, and certain types of investments or financial instruments may not be covered. In regards to the claims process, in the event of a brokerage failure, customers need to file claims with the appointed trustee to recover their assets. The valuation date, securities in customer accounts are typically valued as of the filing date, which is when the brokerage firm is placed into liquidation. So that is what I have for you today. Please hit that subscribe button and the like button if you gain value and you got what you came here for. If you got what you came here for, you gain value, and you're happy with the information you received, hit that subscribe button and the like button right now. See you in the next video.